Welcome back. This is Chart Overload. I'm Ryan Mumy, the CEO of Celinda Capital Management. With me is Justin Greenhill, Chief Investment Officer. And on these, we go through some charts, talk about what we think's happening in the market and the economy from our vantage point, and hopefully you at least learn a little bit and minimally giggle a little bit. We are, I don't know about you, Justin, I believe you're in Miami right now, and you're not dealing with Ice Mageddon 26 like we are in North Carolina. It's everything's shut down.
Nope, but I'm here to make the people giggle.
Yeah, right. And we got, as you heard this morning on our team call, we got snow coming. So people up north, like where I'm from, laugh at us about it, but we just, as you know, can't deal with it. But let's get started. First thing is big picture. This first chart looks at it's catching lots of news headlines on the U.S. dollar. This is the Bloomberg Dollar Spot Index, and as we've seen, it's been a little bit of a downtrend since 2025.
Yep. So this week broke to new lows, dollar index, and yeah, I think that pretty much says that it's really nothing new. I don't necessarily know what we'd attribute it to, but it's important to keep in mind that the dollar index is basically euro, Japanese yen, and it's disproportionately weighted to the major currencies. But as we go to the next chart, which I'll steal your
lead.
I'll steal your segue. If one did have to attribute a very concise causation to what's been weakening the dollar, you could probably say that it's a growing global realization about just how significant and sustained the U.S. deficit is, which that is our second chart here.
Yeah, and that's a big number, big percentage of GDP. Moving on to the next one, recently Trump, putting additional pressure at Davos, talking about the U.S. and Greenland. Lots of concerns from Europe, obviously, and this chart just shows that a lot of U.S. assets are held by Europeans.
Yeah, so this is probably what's maybe missed from some of the headlines at large is you've got the deficit, which is, at least in a normal scenario, in the case of most countries historically, undermining the strength of the currency. But then you also, in the case of the U.S., have a huge concentration of asset ownership by foreigners, right? Which this shows roughly 6 trillion of U.S. equities held just by European, investment vehicles alone. So you combine that with the deficit, you potentially combine it with sort of a geopolitical element or leverage perhaps for why there could be selling. You've got the market starting to increasingly price in a weaker dollar.
And it's not just U.S. equities, 6 trillion, but they own lots of other stuff, 4 billion of bonds and some agencies as well, or 4 trillion of bonds, and then also some agencies. Moving on to the next chart, this looks at consumer confidence, which this week, and again, it wasn't good. Survey data hasn't been good. It hasn't really meant anything, but observing the data, it's still weakening.
Yeah, this is a theme we've been hitting on quite a bit in recent weeks, months, really even maybe quarters, I guess, if you go back to when we first started identifying it. But broad-based deterioration in all the metrics of consumer sentiment. And as we've kind of continued to discuss, it really has meant, at least to this point, very little in terms of what's happened to the stock market.
Yeah, and moving on to this next one, the unemployment rate relative to GDP. Again, the unemployment rate's been ticking higher for some time, and sentiment data is weakened, but GDP's actually from the second quarter of 25 is shot up. And to your previous conversation, it just hasn't mattered yet to the stock market. I say yet because eventually it will, but that could be a decade from now.
Yeah, and if you look at kind of the composition of the stock market, it's really big companies that are doing a lot in terms of capital expenditure. So this most recent chart that you mentioned there that shows the unemployment rate at the top and GDP at the bottom. This just basically goes to show that a huge portion of recent GDP has not come from the consumer, but it's come from capital expenditure, in particular AI CapEx.
Which we've talked about numerous times, is massive. They outspent all other spending, by all consumer spending for the first time ever for the last couple quarters. Moving on to domestic stocks, this first chart looks at the rotation, which many people have talked about. We've talked about where it wasn't just the Mag 7 leading the way. It hasn't been, at least since the beginning of November. Other asset classes, types of companies have done well.
Yep. So this shows small cap Russell 2000 and equal weight S&P. Year to date, pretty notable outperformance versus the market cap weighted S&P 500. So you could call that broadening or rotation, but at this point, it just basically looks like different areas of the market are going to trade relative leadership to the upside, and that's kind of where we're at, right? So it's been a market where if one wants to be short a particular asset, it's very difficult because the things that underperform will then go through periods of time where they really outperform, and it's pretty characteristic of a bull market still yet to this point.
Yeah, and these next two charts really, but this first one just looks at large cap versus small cap, the amount of money that's been invested in them for the last 5+ years is pretty significantly tilted towards large caps.
To say the least. This one's pretty crazy. So, these numbers are obviously hard to calculate, and a lot of criticism of these types of numbers would say they get double counted or triple counted or even undercounted. So, depending on how you look at it. But nonetheless, we don't want to focus on the number. We want to focus on the relative difference. So, this basically shows that since 2020, you've got $1.6 trillion have gone into large caps, and you've had several billion dollars taken out of small cap US stocks. So that just goes to show, what a dispersion there was in terms of that performance, which that could be in the early innings of narrowing.
Yeah, which we've seen, as we pointed out in the last chart. Small caps have outperformed tremendously. In this next chart, it looks at the just taking a small percentage of S&P 500 allocated money and putting it into other smaller mid-cap indices, what it does to them. And it's, again, these big charts are hard to quantify or imagine, but it's a big number.
Yeah, I would say, we often say this is our favorite chart of the particular thing, but this is, I think, my favorite of the moment. So to put this into perspective, if one were to take 1% of the S&P 500 market cap and move that 1% over to what would be the smallest 600 companies, so the S&P small cap 600, that 1% of the S&P 500 market cap would be 37%. So that just goes to show that if this rotation does continue, it's there could be some really big moves in some of these, what we'll call the quote unquote smaller markets.
Which I think year to date, this is the end of January. Year to date, small caps they're up over 7%, and the S&P's up 1.5%, I think. So there's been some sizable outperformance thus far, but it's not 37. That's a pretty significant number.
Well, then imagine what would happen if 5% came out of the S&P. If one were to make the bull case of there to be a sustained rotation, you could say there's a catalyst around, people becoming less optimistic about the payoff for AI CapEx or whatever. But, to my kind of sarcastic comments about the dollar at the beginning of this, what I think I really trying to express there is a lot of times these dynamics, whether it be a recent trend in the dollar or whether it be a rotation, it's sort of, they start for a reason, but then a narrative is assigned, whether it's true or not, and the flows just kind of continue in that direction. So we call it the non-narrative, which is why oftentimes we either laugh or avoid a direct explanation. Flows is usually the answer.
The next chart looks at some of the gamma, the underlying statistical setups of the market. And right now we're kind of right in the neutral zone.
Yeah, so we had options expiration last week, and the market started pretty weak, and then stabilized, and then kind of were right on that precipice. So we wouldn't necessarily say that this is always a signal to think the market's going to crash, but as you can see here, once you get into these types of market positioning dynamics, you do oftentimes see much higher volatility. And as we are all very aware, most of volatility happens on the downside, and most of sustained up moves are actually relatively subdued.
Yeah, so we're just kind of at a watching point here, which we've been communicating since the option expiration, and we've talked about it. We on this show, we've talked about it in our quarterly webinar. We've talked about it privately with our advisor partners and also with clients that, like it or not, around those big option expirations, that has been turning points in market trend. We've been in an upward sloping market trend for some time. And if there was going to be shake and bake in that, if there was going to be a change in direction, a change in trend, we're hyper focused around these option expirations. And right now, it's not saying anything. It's in neutral zone, the neutral area. But if volatility does pick up, if there is some downward pressure, it will make a lot of sense. Next, we're on to our next part, which is non-US dynamics. This first chart looks at emerging markets, relative price to the U.S., and they're clicking new bull market territory.
Yeah, it's interesting when you look at any of these charts, whether it be, I think it was last week or the week prior, we showed, or the last show, I should say, the last chart overload, we showed a chart of Korea, and many of these other markets have gone up a lot over the past year. But what this basically shows is that if you look at the emerging market index, which is heavy in Korea, Taiwan, China, and so on, that recent move is basically a speck relative to history in terms of it had gone so many years up until last year where US stocks had outperformed that, similar to our comments about the dollar starting to get flows where it weakens, or US small cap companies starting to get flows where they outperform. Emerging markets could also be fill in the blank on the narrative in hindsight, but starting to receive flows to outperform, which would be just a mean reversion, as you can see in this chart, right? It tends to.
Yeah, you look at 2000 to 2010, often called the lost decade in U.S. equities. You see this line moving down, meaning emerging markets were outperforming U.S. And to Justin's point, we talked about the massive performance of some emerging markets last year, and you see here it literally was this tiny historical move. So there could be a lot more in the making there. Next chart looks at exports.
This is actually the Latin American countries in terms of where they export to. So basically what this is saying is that, Latin America has been a very strong market of late, and that was during a time when, trade tensions were high, tariffs were put on. And what this is basically showing is that Latin America, with the exception of Mexico, which is mostly to the US, actually has very diverse export partners. So it's been a region that has kind of changed a lot in terms of its economic composition. And really the main thing from that is not only does it have more connection to China than it used to, but the Latin American countries outside of Mexico actually export to a lot of countries that are not the US and China. And one of the big headlines of late was a new free trade pact signed between Southern Latin America and Europe.
Diversifying.
Yep.
Geopolitically diversifying. Next chart looks at the Brazilian ETF that tracks the Brazilian equities as compared to the S&P 500, and similar to the emerging market chart we showed 2 ago. This is just showing a little bit of mean reversion.
Yeah, so this kind of puts what we said into perspective. Despite what was a big year last year for the Brazilian stock market, relative to the US stock market and going back, a couple decades, it's just now starting to kind of pick up on a relative basis off of multi-decade lows. So an important thing to keep in mind when you look at any of these charts is this is basically putting a foreign market in dollar terms. So back to our original comment about the dollar, when the dollar is weakening, not only does that usually mean that foreign markets are performing well, but even if that's not the case, as a US investor, you're getting the benefit of that weakening currency. So all of that is reflected in this chart, which could go to show that if this multi-decade downtrend was money going out of the US elsewhere, I think a big theme that we're talking about is we could be relatively early in money coming out of the US and going back into other parts of the world. And to our prior comment, a small amount of a US market, especially US mega cap stocks, is so much bigger than other markets, it can really move these, what we're calling the smaller markets.
Next chart looks at Brazil's interest rates, and they've kept them really high relative to the rest of the world and especially to the US.
And especially relative to inflation there. So you've really got inflation in the country, more or less what inflation is here in the US, except they've got their rates at 15%. So, and the real story behind that is that historically, there's been quite a few instances in history in which the central bank lost credibility or was, influenced by politics. And 2024 was a situation where for a period of time it looked like that was going to be the case, yet again. But instead, what the central bank decided to do was when the rest of the world was cutting and they had already started to cut rates, they actually reversed and kind of diverged from the rest of the world, started another hiking cycle, and have since kept rates at multi-decade highs. Although they've signaled as of this past week that they're going to start to cut rates this year.
Next chart looks at Asia tech shares relative to the US, the Philadelphia Semiconductor Index and the NASDAQ. They haven't run in tandem to the upside.
Yeah, this is just another chart that kind of looks at it from a different way. These ones prior were looking at price relative to price in US markets. This is just simply showing that if you look at Korea, which had a tremendous year to the upside last year, the Korean stock market, if you compare it to US semiconductor index or US technology stocks, it's still on a fundamental valuation basis very cheap.
Yeah, that's showing price to earnings ratio. So again, all of these things adding up, if dollars leave the US, if they start flowing into other areas, there's still some relatively fundamentally price metrics cheaper areas to be than the US.
And just one more point on that. This kind of goes back to how we started by showing what the dollar's doing, and then we were a little bit reserved in terms of saying why the dollar is doing that. The reason is that the dollar is one of those things that in hindsight you can say why it's moving, but the important thing is it moving? And then once you observe that it is moving regardless of the reason, you can then go lower and determine what could be ripple effects that, as we're showing here in this presentation, can affect all sorts of different asset classes.
Yeah, we've talked about that a lot of people just want to talk about the whys, and the question isn't why, the question is what do you do with it? What do you do with the data? What's your response mechanism? And yeah. Next section is interest rates. This first chart looks at the 10-year U.S. Treasury yield relative to the federal funds rate. And as we see here, the Fed's cut and rates have stayed elevated.
Yeah, and you could look at this chart and say that it's equally interesting that when the Fed funds rate was much higher, 10-year Treasury yields were notably lower than that. So it's been very historically different, or we should say it's been different relative to history this time around, in that that inversion that you see at the beginning of the chart, short-term yields higher than long-term yields, historically that's been an indicator that a recession was coming. Not only did a recession not come, but the Fed ended up cutting rates, and while it cut rates, long-term rates have basically been unchanged the whole time. So back to our comments around the dollar, the bond market is another one of those big global markets that is going to move based on a variety of different reasons. And if one was forced to put a narrative behind what's happening in the bond market or the dollar for that matter, you could say the US deficit and geopolitical dynamics. But again, it's more important to acknowledge what is happening, and if it's continuing to trend, then try to explain why for these big global markets, because there's so many different participants worldwide that are voting on that, all day, every day.
Next chart looks at volatility in U.S. rates, and they've been trending lower, historically almost near low points.
Yeah, so this is another one of those things that, seems somewhat interesting, is that you could maybe think that if there was these big moves happening in the currency and all these different geopolitical dynamics around the deficit, you would assume that the US bond market is having a lot of volatility. And what this chart shows is, the opposite has been true. So whether that's why, sometimes we become a little bit cynical. I think maybe we should explain this humor, explaining a, linear, this happens because of this. And the reason is that I think, as we've shown several times throughout just this presentation, a lot of times not only does that not happen, but the opposite happens. And then, if you try to explain what you expect too clearly, it's then even more impossible to explain when the opposite happens. So this is perhaps one of those dynamics too. So moving to the next chart, you see the 10-year.
You keep stealing my thunder. Look at that.
Yeah.
You're not going to need me.
That's been the plan. We're psyoping.
Not subtle either.
Well, we're psyoping you out of this organization. So
it's good.
10-year treasury yield, which, as you can see, it's moved very little of late, which directly corresponds with the fact that, the prior chart shows that bond market volatility has been in decline.
Last section looking at commodities. This first one looks at gold as as the raw number of central bank reserves. It has overtaken treasury holdings,
which is pretty remarkable. And again, I'm going to just beat a dead horse right now by saying that the narrative as to why that's happened seems obvious in hindsight, but what one would explain it as, back when the U.S. Seized a bunch of assets from Russia in 2022, there's a belief that at that particular time, a lot of global central banks really ramped up their diversification out of U.S. treasuries, which is what you can see in this chart. So there's just an enormous rise in terms of central banks' accumulation of gold. We think what's most important for everybody to keep in mind, amongst all the excitement around what's happened with metals and precious metals in particular, is what we just said has already happened and is already in the price, right? So in order for you to think gold is going to go up over the next year as much as it's gone up over the past year, you've got to assume that some participants, be it central bank or other types of market participants, are going to buy as much as they bought in the past year. And although it's possible, that becomes harder to do over time.
Yeah. And we've, internally, we've been warning our advisor partners. They've been getting a lot of inbound calls from clients talking about participating in the precious metals markets. And we just warned them that commodity cycles are vicious. They're not like, you can't compare them necessarily to the stock market, and to be very, 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 very careful. And going on to this next chart, you kind of see it. This is gold's weekly chart. That is first and foremost, I was nervous we weren't going to get some of your artwork in this chart overload. So you've answered that. Thank you. But second, that is a wicked ugly candle right there on the weekly for gold.
Yeah, so it's kind of happening as we speak today, but the entire metal complex, gold, silver, copper, etc., had a big up day yesterday, had a big reversal, and then this chart doesn't fully reflect it because it's a weekly chart, but huge move going on today. If I'm not mistaken, as we speak, what is silver down? 30-some% on the day.
On the day, yes. I mean, and again, we've talked about the silver boom bust cycle like on several shows ago, that just be careful, right? You just be careful, like what's happened and what, the narrative, back to our topic, it's already in the price. The question is what will drive the price more, and just have to be really careful with
Just
these things.
to add kind of a thought to that, it's also really important to acknowledge that the story around why silver's going up or why gold's going up or why copper is going up, for that matter, the story around why Nvidia went up a lot, we're not ever trying to say that those stories aren't true. We're not saying that, there is potentially a reason why silver was undervalued and has repriced. But what we're also saying is that in any and all bubbles, the story is the best at the top. So, not that we're calling it to be a bubble. I mean, we could be in the early innings of a multi decade move higher in gold because of, again, fill in the blank on the narrative. But we also have to acknowledge as risk managers first that the story is the best at the top.
And so commodities are boom bust cycles with wicked corrections, which was a chart we showed from Brent Donnelly several chart overloads ago. Like, even if it was in a multi-decade expansion or commodity boom, there's going to be some 30 and 40% corrections along the way. And I don't know that most individual investor clients, non-institutional, non-professionals, can stomach that or are aware of that risk. But anyways, the last chart looks at Brent crude oil.
This just basically shows that, oil had several weeks of decline here up until the most recent week, and then there's been a pretty big jump. So the narrative at the moment is, escalating geopolitical tension with Iran. But Mr. Ryan Mumy and I were speaking about this yesterday, and we're thinking that, really what a lot of it is it kind of comes back to positioning, right? So in all of these markets, increasingly so, there are a huge number of participants and, billions and billions, if not hundreds of billions or even trillions of dollars of global capital that simply go with the momentum in various markets, right? And yeah, they might have a narrative, they might not, but it's really it's a flow momentum type thing. And what had happened into the most recent dynamic was a lot of this positioning was, short or was underinvested in oil, and then you often have some of these squeezes. So we are reluctant to say that oil is in a new bull market, although, who's to know? But unlike, say, copper, unlike, say, gold, there is, plenty of supply of oil that can come online relatively quickly.
Yeah, and the question is, does the need for that supply exceed the demand for that supply? Does it exceed the actual production of it? And to be determined. I know one thing: the charts and the data will show us. But that's this episode. We appreciate you tuning in, spending some time with us. If you would like to talk about any topic or chat with Justin or I a little more, you can reach out to us at info@solinda.com, info@solinda.com.
Slide in my DMs.
Slide on in. We'll be back in 2 weeks with some more chart overload for you, but we appreciate you tuning in. We'll see you next time.